Hello and welcome to NDTV Profit. You're watching IPO and the company which is coming to the markets next week is Ellenbarrie Industrial Gases. It's a 50-year-old company manufacturing various gases, including industrial gases and specialized gases. And joining me today is Mr. Padam Kumar Agarwala, who is the Chairman and Managing Director of the company, and Varun Agarwal, who is the Joint Managing Director of the company. Gentlemen, thank you very much for joining us on NDTV Profit. Your IPO is opening on June 28 and closes on 26, price between 380 to 400 rupees per share. It's a fresh issue of 400 crores and OFS of 452.5 crores. So roughly around 852 crores is what you're raising, and that gives you a market value of 5,637 crores at the upper end of the price band. Mr. Padam Kumar Agarwala, give us a sense of the kind of industry that you are in, what is the business structure that you have, and what are the business verticals that you have?
Okay, we started with air separation gases, that is oxygen, nitrogen and argon, and that remains our mainstay. Other than that, we are also manufacturing a number of other gases and distributing some, which are quite synergistic to the main business of air separation gases. The customers are generally the same. Other than that, we have businesses in terms of EPC. We make complete plants for air separation and related equipment and directly sell them, or we also supply to them, to our customers on long-term contract basis, with operation and maintenance being done by us. We also have business in healthcare, which emerged mainly out of the needs arising from COVID, and we do hospital pipelines and turnkey supply, total gas management with regard to the hospital ecosystem. So these are generally the main businesses in the company.
Varun, can you take us through the 400 crores that you are raising with respect to how you're going to use it?
Sure. So the 400 crores is primarily for three purposes. The first is to set up a greenfield expansion plant of 220 tons per day in eastern India. This plant is located adjacent to one of our existing units, which is running at 100% capacity. So there is a need for capacity increase there. Another significant portion of the proceeds will go towards repayment of our debt. And lastly, about 100 crores out of the 400 would be towards general corporate purpose.
Mr. Agarwal, can you give us a sense of the kind of market we are in? Because you are eastbound, which is with major facilities coming in West Bengal. How big is that market for growth?
Gases are everywhere, and the market generally anywhere would grow faster than the rest of the industry. There are no published numbers in terms of the market size, but we see generally a growth exceeding 10% in all geographies. Yeah, we are strong in East and South India, but at the same time, we also cater to customers in the rest of the country.
And how do you transport these gases across the country? Because transportation is the biggest thing for gases. So how do you do that in that sense?
So, we have three modes of delivery to our customers. The first mode of delivery, which is the most important in terms of our revenue contribution, of about 2/3 of our revenue comes from delivering liquefied gases to our customers. Here what we do is we liquefy the gases in our plants and then transport it via tankers, which are owned by the company, to the customers' factories. Liquefying the gases allows us to reduce the transportation cost drastically. So it's sort of similar to, like how natural gas is liquefied into LNG and then transported. So that's about 70%. About 15% comes from supplying in cylinders. And these are cylinders you've probably, all of us have seen, probably in a hospital or in any sort of a small factory. However, the cylinder supply radius is quite limited because there the transportation cost is quite high. And the third is, where we call it the on-site model. And here what we do is for our very large customers, we set up our manufacturing facility inside the manufacturing facility of the customer and directly supply the gases to them via pipeline. So these are the three sort of distribution models, and this is what sort of differentiates our industry, because you're supplying in sort of three different mechanisms.
Varun, can you also take us through your financials once? Because I'm seeing roughly around 20% odd jump from FY24 to 25 in revenues, but your PAT has almost doubled in that, and your EBITDA margins have also gone up from 22 to 35%. What has led to this huge jump in EBITDA margin and PAT?
Sure. So you're absolutely right. Our revenues are up over sort of, if you take FY23 as a base and compare to FY25 numbers, revenues are up 50% in 2 years, and EBITDA and PAT are up 3x in 2 years. And that's a result of significant margin expansion. Our EBITDA margins are close to 35%. Large portion of the expansion in margins has been driven by greater capacity utilization. As we are increasing our capacity utilization and growing in size, we are achieving significant operating leverage. The other thing is sort of a higher margin revenue mix. So typically, our revenue from on-site business has higher EBITDA margins. Our revenue from sale of argon gas has higher EBITDA margins. And these two have contributed higher in terms of share of revenue in FY24 and even more so in FY25, leading to an increase in the blended EBITDA margins for the company.
So what is the mix between on-site and your manufactured gases as of now in terms of revenue?
So about 15% of the revenue comes from on-site, and 85% comes from our merchant plants. But the on-site revenue, the way we book the on-site revenue is at a gross margin level. The revenue is recognized at the gross margin level itself. So which means even though it contributes only 15% to the top line, but it has an oversized impact to the EBITDA and PAT.
Okay, because you're not able to, there's no depreciation or anything which is coming in, so directly it comes to the PBT level basically.
Yeah, so effectively what happens is, our main cost of production in terms of COGS is power. As you know, the air separation gases that we manufacture, oxygen, nitrogen, and argon, they are manufactured from air, right? So, this is probably the only manufacturing company which has a zero raw material cost because air is obviously free. The major cost item for us is power. In case of our on-site plants, the power is actually provided by the on-site customer. So we recognize the revenue net of power cost, which is what makes those margins significantly higher.
Okay, point taken. I was looking at your sectoral exposures. You have an exposure of really 26% for pharma, which has come down from 29%, but steel has gone up from 28 to 37%. Are we to assume that this is the kind of capex which is building up in steel plants in that region? You've been able to tap to those customers, and you've been able to push your products much there?
So look, steel, is always a very important end-use sector for industrial gases, right? Having said that, we as a company are very cognizant of keeping our steel exposure under control, right? Because ultimately we want a well-diversified customer base. So while steel has gone up in the last financial year, largely due to commissioning of 2 new plants, both of which are located within steel companies' premises, that's led to a increase. However, we are taking sort of conscious efforts to ensure that the end-use revenue base remains diversified, the customer base, and you would see probably the contribution from pharma and healthcare going up in the subsequent years with the incremental capacity that is coming through.
How does these contracts work with respect to the on-site plants? Are these long-term contracts, and you get an AMC as well, along with some basic cost for the operations there? And what is the kind of order book that you have for more on-site plants, because those are more margin accretive for you?
Sure. So the contracts are typically 15-year contracts with 5-year extension clauses. So you can take it as a 15 plus 5 20-year contracts, and these contracts are fixed in nature in the sense that we get a fixed monthly revenue from these contracts towards cost of us setting up these plants for the customer and for operating and maintaining these plants. These plants continue to remain on our balance sheet because the monthly revenue is fixed, and of course it's subject to escalation linked to inflation. So we have very clear cash flow visibility over the 15-20-year tenor of the contract. Last year, second half of last year, we've commissioned 2 on-site plants. One of them is a 600 tons per day plant. Another one is a 170 tons per day plant for 2 on-site customers. Currently, we are setting up a 220 tons per day merchant plant and planning to set up another 2 plants, one of which is a 320 tons per day on-site plant, and the third is another 220 tons per day merchant plant. So if you look at it from a capacity perspective, historically we had a capacity of 600 tons per day. Last year we commissioned another plant of 600 and 170, thereby taking our current capacity, which is on our balance sheet, owned and operated by us, to 1370 tons per day, and currently in the process of setting up another 760 tons per day, which will take our net capacity to over 2,100 tons per day. So yes, the growth prospects remain strong, and these are just some projects which we are undertaking now or planning to undertake now, and with a sort of strong pipeline in the future, because ultimately we want to be an all-India player. Currently our capacities are focused in east and south of the country, and we will gradually plan to expand in north and west of the country. So there is significant upside. You got to remember that our market share is in sort of low to mid single digits. So the room for growth is significant for us.
Mr. Agarwal, given the fact that you have now a revenue mix coming which is more going towards on-site, will you be looking at expanding that to other regions as well with respect to west and north?
Well, definitely we want to be there in all the geographies of the country. From east we move down to south, and definitely west and north will be our aim. It would not only be, the focus would not only be on on-sites, we would also look at merchant. To explain the difference, on on-site you have one dedicated customer, and on a merchant plant you produce at one location and supply to about 100 and odd customers in the nearest geography. So it is our endeavor to be present in other regions as well, and at the same time with both merchant and on-site offerings.
Varun, what is the kind of scalability with respect to margins here? I understand that as more on-site comes in, the margins will go up for you. But is there a kind of a normalized level of margin that can happen, and at some point in time, the mix between on-site and merchant will it be much more on-site and less merchant?
So look, our goal is to have a good mix of on-site and merchant, right? Currently with the capacities that we have and that we are planning to build out, we would be at roughly 50-50% in terms of on-site and merchant by production capacity in tons per day, right? Now, if we want to keep that strategy going forward, I would say that currently we are doing an EBITDA margin of 35% odd, with greater contribution from on-site business, with greater revenue contribution from Argan. We could see significant upside to these margins. Just to give a example, the industry leader in terms of margins has an EBITDA margin of close to 50%. So there is room for us to grow from this current 35%, and with the new plants coming in on stream, which were commissioned in the second half of last financial year. This year, obviously, we get a full year running impact of these plants. So we should see an improvement in the EBITDA margins.
You're paying off your borrowings as well of 210 crores. Will that make you net debt zero by the end of the fiscal?
Yes, we would be at zero debt. In fact, we are almost already close to zero debt. However, we've got a lot of capital work in progress. We've got a lot of investments on our books in terms of our treasury. Once we repay whatever outstanding balance we have, the company would be fully deleveraged with a decent kitty of money which is available for it to grow. We have significant expansion plans, and this sort of sets the stage for us to be able to grow rapidly. We can always, going forward, take on leverage for our future expansions. So it just sets up the stage for us to grow on a regular basis, and then the cash flows from our operations would then be sufficient to sustain our future growth going forward.
The capex, capital work in progress, which you mentioned, which includes 1 merchant and 2 on-site, when are they expected to go on stream?
So the first merchant plant is expected to go online in sort of the beginning of the second half of this financial year. And that's one of the plants for which we are raising money in the IPO. The other 2 plants, we are planning for one to go on stream in Q4 of this year. And the final merchant plant, we are planning for it to go on stream about a year from now, so Q1 of FY27. So that's our broad strategy in terms of near-term growth.
Gentlemen, it was a pleasure talking to you today. Your IPO is opening on June 24th and closes on June 26th, price between 380 to 400 rupees. It's a fresh issue of 400 and OFS of 452.5, and the company is valued at a little over 5,600 crores at the upper end of the price band. Thank you for watching IPO.